So when you're talking about buying negatively geared properties, it's going to cost you money to own that property. So that's one factor. And if you do have more money or more equity that you do have available, and a really good opportunity comes up in a more prestige suburb that has some awesome capital growth, and I'm not always saying that prestige suburbs always have capital growth, but just from experience, I own some higher end properties, and the capital growth on those properties versus a cheaper one, or owning multiple cheaper ones, has been far better in that regard. So I was constructing them, so building them with the intent of keeping them, renting them out positively geared. With interest rates going up, they've gone back to being slightly neutral. So the intention was to have them positively geared. If you were to purchase them in the current market, they'd technically be negatively geared if you were to gear it to 80% loan to value ratio. So from the onset, it doesn't look like a good investment if you were to buy it at market. And the market's had a big run, but it's going to have a bigger run. But if you were to compare, say, the properties that I've got, luxury, a couple of luxury properties, the value of those $1.5 million, and most of that growth has only been over COVID, so it's been $400,000 or $500,000 in capital growth. So they were supposed to be, around about $1.1 million properties, and I was expecting them to be positively geared. At that time, the only reason I could generate these properties to be positively geared was that I was actually building them. So I was building them expecting that there'd be a bit of upside from the build, but then obviously COVID came along, and that upside went from the $100,000, $200,000 I was expecting to sort of $500,000.